Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to another day of the show. It's the Real Investment Show. It's a Monday. It's Columbus Day today. So the stock market's open, but bond market's closed. So again, no action in bonds today, but stock market is open today. Of course, this is kind of an interesting day also. It begins the literal rush of earnings season. Now, so on Fridays we had banks, but really starting this week and very much into next week, we're going to have just a rash of earnings to go through. Of course, all of your big mega cap stocks are happening next week. Apple, Microsoft, Google, those guys. And again, buybacks are in blackout for the moment, but by the end of next week, we're going to start to rapidly reopen that back up. And right now, we are at $988 billion worth of authorizations for 2024. So just knocking on the window of $1 trillion. And about 22% of all those buybacks will occur between November and December. So just big support for markets. Now this all kinds of lines up in a couple of different things we'll talk about this morning. So just kind of keep that in mind, that there's a good bit of buying demand that is waiting to come back to the markets for the last 2 months of the year. Outside of that, on Friday, of course, we had the PPI report, CPI last Thursday. And both of those came in pretty much as expected. They weren't dramatically hotter than expected. We're going to touch a little bit on CPI this morning. There was a couple of components kind of ticked up a bit. There was a couple of anomalies in the data as well that'll likely get revised out. But overall, pretty much in line with expectations. The only difference, or really the only impact from both of those reports, is that it probably keeps the Fed on pace to cut 25 basis points in next month, rather than the 50 points that a lot of the markets are hoping for. But markets have pretty much vastly gotten beyond that. They're okay with kind of where things are right now. There's a lot of demand for equities at the moment. And the equity put-call ratio now is back to some of its lowest levels that we've seen. High-yield credit spreads are the tightest since we've seen those since 2007. So you got to go back a ways to see a period where there was absolutely no perceived risk in the overall markets at all. And that's pretty much what we see at the moment. Lots of optimism, lots of enthusiasm. There was an interesting chart out this morning. The median value of stock portfolio investors, this is according to the University of Michigan, has surged to $250,000 over the last 2 years. Now that's up from about $130,000 to $250,000 in just 2 years. It's just a vertical line straight up. So it's been a very good couple of years for markets. In fact, as we talked about last week, this is the best year for the stock market performance since the turn of the century. So, I mean, markets are just doing extremely well this year. You're up over 54% from the lows 2 years ago. So you've had just a phenomenal return. So again, if you're invested in the markets, you're doing fine. There's nothing to worry about at the moment. If you're not invested in the markets, you're not real happy right now. So, that's kind of where things are. And people, that sentiment is really kind of getting embedded into markets kind of all across the board. So outside of that, lots of earnings this week. That's going to be the main focus of the markets here over the next 2 weeks in particular. In particular, attention is going to be the focus on Apple and Google and the AI trade. Right? That's the stocks involved, Google, Meta in particular. Their worries right now, there was an article out by Deutsche Bank this morning. The worries by Google and Meta right now in particular are underspending on AI, not overspending. And there's a huge ramp up in spending. Over the weekend, the CEO of NVIDIA came out and said that demand for the Blackwell is not just insane, it's absolutely crazy. They have so much demand for their AI chips right now. So again, we're going to see a lot of that. Of course, NVIDIA reports late. They report in November. So it's going to be a while before we hear from NVIDIA in terms of their earnings. But the demand for AI is certainly not going away. So we're likely going to start to see some of that trade kind of come back into those stocks that have kind of lagged here over the last couple of months. And in particular, big hedge funds that have been selling stocks for the last 8 weeks, they've now turned on the buy spigot. They're now starting to buy because they're getting caught behind this trade. Speaking of the trade, let's talk about what you need to know before the bell this morning. The seasonal buy signal, we've talked about this previously. There's a seasonally strong period of the year. There's a seasonally weak period of the year. The seasonally strong period of the year runs from October until May. Historically, the weak period runs from basically kind of end of May through September, early October. You've often heard this called the best 6 months of the year. And if you had invested only in the best 6 months of the year, historically, you've outperformed the markets enormously because the weakest period of the years occurred during the summer months, and that's where a lot of the pullbacks have occurred. And again, we had that 10% correction last year in the middle of summer. We had a correction this year in the middle of summer, right? So not surprising. Stock Traders Almanac has been working on this for a long time. They've been doing research and they've developed signals for this, but they've determined that you can apply some technical analysis, like everybody does, to this to try to time the beginning of that seasonally strong period of the markets. And on Friday, the markets broke out to a new all-time high, and we triggered a short-term buy signal again back onto the market. So again, in the short term here, markets have been doing fine. We went through this consolidation period. We've now broken out. We've talked about this a bit. We formed this kind of cup and handle pattern that we had discussed previously, where the markets had made kind of these two higher lows and then broke out of this kind of resistance level we've had. We then retested that support level, bounced off of that, have continued to break out to new highs. So this all kind of confirms that the bull market remains intact, and there's certainly not any big risk right now that investors should be overly concerned with. Again, markets are a little bit overbought here near, short term. So again, continue to manage risk in your portfolio. Just, don't throw caution to the wind. But again, nothing really overly to worry about at the moment. And markets are set up well for moving into the end of the year. This is potentially going to turn out to be a very, very strong year by the time we get to year end, unless something happens post-election, right? I mean, there's certainly some risk out there that we need to be aware of. But right now, the trend is clearly positive and markets are doing what they're supposed to do. Now, on a weekly basis, we can, and this is the, kind of the important point. On a weekly basis, we have now triggered a buy signal. And again, weekly data kind of slows things down. And, earlier back in June, we were talking about some risks to the markets and said, hey, this market is likely going to go through a correction, et cetera. We're going to have a 5%, 8% correction or whatever. And that was because we were triggering a weekly sell signal at that time. And again, then markets sold off. We've now triggered this buy signal again as the markets broke out on Friday. Now, this also corresponds, this buy signal on a weekly basis, which is much slower to move, also corresponds with the beginning of the seasonally strong period of the year. So we now have a seasonally strong buy signal or a stock market buy signal on a weekly basis that corresponds with the beginning of the October, or really kind of the seasonally strong 6 months of the year. This suggests that right now that markets will continue to push higher at least into year end. Again, we also have the effect of buybacks coming back, etc. So at the moment, there's not a lot of risk in the markets other than just markets kind of continuing to grind their way higher. Now, they're not just going to shoot straight up, but again, I would expect the markets to continue to kind of bounce their way higher through year end. Anyway, seasonally strong period is in. We'll talk some more about that. I've got an article coming up on it as well. That's what you need to know before the bell this morning. When we come back, we'll talk about the NFIB report out. Had some interesting data in it. We'll talk about that next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a few things to get into this morning, because I wasn't here on Friday. So we've got to catch up on CPI and kind of some of the other economic data that's running around from last week. So again, technically, we're back onto a seasonally strong buy period. Now, that doesn't mean that markets are just going to go straight up, right? So don't assume that. Markets will likely trend higher over the next 6 months, but there's going to be some bounces along the way. Some data is going to come out. You're going to have, 3, 5, 8% corrections along the way for a whole variety of reasons. And again, there's a lot of impacts that can come along that we don't know about. And that's what generally gets markets, is some exogenous event that we're unaware of. And markets are overbought here near term. So even on a weekly basis, markets are getting pretty extended, which would you would expect to have a pullback here at some point that would give you a much better entry point to add exposure to portfolios. I'd be a little bit careful, saying, oh, well, Lance said it's a seasonally strong buy period, so I'm going to go jump into stocks right now. It's can't really do that. But, pullback should be contained between the 200-day moving average and where we are now. And that's going to be a significant decline. I mean, you can get a 10% whack in here somewhere, and that wouldn't be out of the ordinary at all. 5 to 10% corrections are absolutely normal in any given year. We've had 3 this year. We've had a 5% correction back in April, 8.5% in June, then another 4.5% correction just after that. So, this year, while this year is the best performing year on record going back to 2000, you've had some nice little bumps along the way, right? They've given you some good opportunities to put capital to work at a much better price. So just be careful chasing markets. But again, the risk at the moment of a much deeper contraction, those expecting, 20, 30, 40% declines, that's probably not in the cards right now. Now that doesn't mean it can't happen. Something absolutely kind of blows up in the market somewhere that nobody's expecting. Sure, it can absolutely happen. But historically speaking, you need some type of exogenous event to cause that to occur. So outside of that, right, everything else that we know, CPI, inflation, economic data, etc., all suggest that markets will be contained to their shorter-term moving averages right now, at least for correctionary periods. Okay. So let's talk a little bit about CPI last week. Lots of headlines running around, lots of talk, lots of discussion. Got tons of emails about the inflation data. So bring up this chart for me. So this is an analysis of the CPI report, and this is really important for you to understand. There's a lot of stuff that goes on with CPI, and we see these kind of headline numbers, and then we start making analysis on that, saying, okay, well, this means that 1970s inflation's coming back or whatever because it was up 0.2%, whatever. Got to be careful with the data, and you've also got to understand when there's anomalies in the data. So the latest CPI report had both of those. So first of all, understanding how CPI is calculated is crucially important. If you will notice, food and beverage makes up about 14% of the index. Apparel makes up 2% of the index. Transportation is 17% of the index. Housing, 44.6% of the index. It really doesn't matter what else happens in the index outside of housing, because it's such a huge component of that index. So if housing, and it is, we're going to continue to see that moderate lower, still coming off those big numbers of, again, this is, year-over-year basis, month-over-month changes. But, coming off that big spike that we had back in 2021, this is going to continue to kind of moderate itself lower. And that's going to contain the rise in CPI overall. Now, there was an interesting piece of data in here as well with apparel. Apparel has been not doing a whole lot since May. And it's really, this has been the case over the last, year and a half. Apparel really hasn't done much, right? It's not been a big change to apparel. It adjusts mildly, But there's mostly been deflation in apparel. In July, it was down 76 basis points. In August, it was down another 61 basis points. And then in September, it was up 1.35%. Now, apparel only makes up 2% of the index, 2.5% of the index. So it's a negligible point. But when you have big moves in data like that, it tells you that there's probably an anomaly in the data, or there's something wrong with the data. So again, just, there wasn't this, and probably what will happen in the next month or two, this will get revised out and apparel will get back to where it's supposed to be. But again, what you're looking for in the data is, big changes to data that don't really fit within the trend itself. Medical care is, healthcare is about 7% of the index. It bounces all over the place. It was up 16.8%, up from 15.3 in August, but that August was down from July, where it was 16.3%. And basically in June, medical care was 16.8%. So basically, medical care has gone nowhere in the last 4 months. It looked like it did, had a big jump in healthcare costs last month. It really didn't. It's the same as it was back in June and May. So again, just kind of more stable, really, in healthcare. And again, this is what you're looking for when you look into this data. Say, okay, is there a trend in the data that I need to be aware of? Energy costs have been declining sharply, obviously, because of the drop in oil prices. Now, there's been a recent bump in oil prices from being very oversold. We're likely near the end of that process. So again, energy stocks have done well here. May want to take some profits. But, overall, the trend is pretty clear. Housing is declining, and that's the big driver. So again, inflation is going to continue to moderate back towards that 2% target. Again, you just look at the internal components of it, it tells you that's exactly what's going on. And importantly, when we take a look at the data, for most of us, and I'm not saying everybody, but for the vast majority of us, the housing component, 44.6% of the index, and the healthcare component, 7.8% of the index, which makes up, 51% of the overall calculation, those are mostly fixed expenses for the vast majority of Americans, right? We talked about this earlier this year, is that healthcare gets reset at the beginning of the year. So you generally have a big jump in healthcare costs at the beginning of the year, and then it's stable until you re-enroll at the end of the next year. Housing, you're under contract. Either you've got an 18-month rental agreement, so your rent is the same for 18 months, or you have a mortgage, or you have no mortgage at all and you're not paying anything. But your mortgage payment or your rent payment is pretty much fixed for a set period of time. So if we extract those two things from CPI, we get a better indication of what the day-to-day changes of inflation are for the average American. That's only 1.06% right now, so well below the Fed's target of 2% on what the rate of change of inflation. Now remember, importantly, this is the rate of change. It doesn't mean that prices are lower. It means that the increase, the percentage increase in inflation is slowing down. This is the mistake that a lot of people make. They go, well, everything in store is still higher. Yes, it's still higher because we still have inflation running. And no matter how you want to measure it, you can look at the CPI at 2.4%, the core CPI at 3.2%, or CPI less housing and healthcare at 1.06%. All of those are higher. It all means that inflation is still going higher, right? The goal of the Fed is to grow inflation at 2% a year, actually 2.4% a year, because the long-term average of inflation runs at about 2.4% a year. And that's the important point about all this, is that when we take a look at inflation, what the Fed's trying to do is get inflation back, and I'm going to skip down to another chart here real fast for you. But if we look at the long-term month-over-month changes of inflation, they're all over the place. They're higher, they're lower. Inflation's higher 1 month, it's lower 1 month, whatever it is, but you average all those out, the average rate of inflation is 2.4%. This is why every time you see a CPI report, the estimate is 0.2 for inflation. 0.2 times 12 is 2.4%. So going back to 1993, the average rate of inflation has been 2.4. It's all over the board, right? But its average is 2.4%. This is why the monthly estimate is always, without fail, 0.2%. And then we go, oh my gosh, we were hotter or colder than that 0.2% increase. Can you go back to that chart? I'm not quite done with it yet. So what I've done on this chart is the black line is CPI, and if you're driving, don't worry about it. You can go pull this weekend's newsletter or watch the video. Which while you're watching the video, be sure and like it. Hit that little like button for me, that thumbs up. Appreciate it. If CPI keeps printing 0.2% inflation every month, as expected, inflation will fall to 1.9% in April of 2025, below the Fed's target of 2%. It will then increase to 2.4% by the end of next year. Because if you're doing 0.2% a month on inflation, inflation will be 2.4% a year. Now, that's not going to happen that way. Inflation will be lower or higher. It's going to be all over the board. That's why CPI isn't a flat line. But the average is 2.4, and that's why the Fed, that's their target. All right, quick break. We'll come back. We'll talk a little bit about economics and what was in the latest NFIB report coming up next on The Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Slept right through my alarm this morning. My wife woke me up. I was in the middle of this dream when she woke me up of the alien armada coming to Earth.
The Real Investment Show podcast.
My wife's ex-husband's new wife is a flat earther. She believes the Earth is flat. And so in my dream, the alien armada is coming to explain to her that the Earth is actually round.
Same show, your schedule.
Nice.
Anyway, I woke up late, so here I am.
I bet you Richard could do a script treatment of that one.
At realinvestmentadvice.com.
I'm thinking more like Mars Attacks. That was the one.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So when I came in this morning to the studio, I told Brent that it was going to be a 3-cup of coffee day because this past weekend was my youngest daughter's 18th birthday, and all she wanted for her 18th birthday. So she is the captain of her, or colonel, excuse me. I would be reprimanded severely for that. She is the colonel. She is the head. She is the head honcho of her dance team at Cinco Ranch High School. And so she wanted to have her officers with her for her 18th birthday. And so we rented a house. Interestingly, we're going to rent a house down in Galveston, right? Go rent a beach house, let them play on the beach for the weekend. And the HOA down there will not allow you to rent a house for more than 10 people. So if you have a big family, I don't know what you do, but anyway, they don't want any more than 10 people at the house. So we wound up renting a house up on Lake Conroe, which is if you don't live in the Houston area, it's on the north side of Houston. And we said, okay, hey, we'll rent a pontoon boat. They can go out on the pontoon boat and spend the weekend. So I spent the weekend with 12 screaming girls, and I'm very tired today. But I've told you before about my dogs, and they're little. They're not little, but they're 28 pounds, right? So I've got one that's half half German Shorthair Pointer, half Terrier. The other is half Terrier, half Ashani, and they're both about the same size. Well, the little brown one, he is solid muscle. I mean, when I go to the gym, I have a picture of that dog because I want to look like him. I mean, when he just sits still, his muscles are flexing and rippling right through his body. He's very muscular as a dog. And he loves water. And so my oldest daughter had come in from college to celebrate my youngest daughter's birthday. And there were some paddle boards at the house, so they got the paddle boards out, and Sniper loves water. He jumps on the paddle board with my daughter, and they go paddling out. He also likes ducks. And so he's on the paddle board. Her boyfriend is behind her, paddling behind her on another paddle board, and Sniper eyes a couple of ducks that are about 50 yards away from where they are right now. So he goes diving off of the paddleboard. In that process, tangles himself up in the cord that is on the paddleboard that attaches to your ankle, right? So you don't lose the paddleboard if you fall off. Tangles himself up in it. He's now swimming, tangled up in this cord, pulling her behind him. Well, when he jumped off, she got worried about him, so she dropped the paddle to go grab him, and so now he's towing her. She doesn't have a paddle. Her boyfriend behind her is paddling frantically, trying to catch up with, and he's beelining towards these ducks, right? But he's such a strong dog that her boyfriend can't catch up with her on the other paddleboard. So now she's screaming because the Sniper's swimming towards the ducks. He can't catch up with her, and finally the ducks fly off, and then Sniper gets back on the paddleboard. So
tell me you got video of this.
I unfortunately no. I was not available to get video at that moment, but it was quite hysterical. But anyway, it's surprising me how strong that little dog is. Man. So I now have new motivation at the gym.
Yes.
But anyway, the long story short is I am very tired today after 2 days of 12 girls screaming and laughing and giggling all night. They do not sleep. My bedtime is around 9 o'clock. Theirs is somewhere around 4, and they get up at 8. So, very sleepy today. All right, let's talk a little bit about economics. So, a couple of things that are going on right now. If you take a look at, and I wrote an article on Friday talking about the GDP report, and the economic data does not suggest that we are near recession territory at the moment. So despite the fact we've got a lot of people doing videos and everything else saying, hey, we're about to have this massive recession, it's going to be this, it's going to be that, the data just doesn't support that. And you don't have to look too hard beyond that. And we talked about this a little bit on Friday. In this weekend's newsletter, we discussed this a little bit more. However, there is data that is certainly concerning, and I don't want to dismiss that data. And as always is the case, what our job is as investors is to analyze both sides of the situation and try to make the best decisions for our portfolio, right? Don't let kind of one side of the data overwhelm another side, or, what we're trying to avoid is confirmation bias in particular. If we take a look at employment, there's nothing wrong with employment. Employment right now is running at about the average monthly rate going back to since the turn of the century. It's declined. It is slowing. Despite that big bump that we had in that 245,000 job report that we had last month, it's well within the trend of slowing employment growth. So the employment is slowing down, but it's returning back to normal average levels of employment, not recession yet, right? And so this is important, right? This is, yes, employment is slowing down. There's certainly some concerns about employment, but it's not weak enough yet to suggest that we're on the verge of recession. Wage growth, which is critical to the supply-demand factors in the economy, is slowing down. We had a big spike in wage growth during 2021 and 2022 when basically we shut the economy down and people couldn't hire. But wage growth for the bottom 80% of workers is declining. Now, interestingly enough, wage growth for the top 20% of supervisors has dramatically increased. So we're, on an annualized basis. But wage growth is still running around 4%. So again, not recessionary. Wage growth would have to slow a good bit more. And we'd also want to start to see potentially a faster pace of declination of wage growth if we were truly entering into a recession, right? And we're not there yet. It is trending lower. It is rebalancing itself for the economy, but it is slowing. That's going to have, and again, that's going to slow down economic growth, because as wages grow more slowly than inflation and economic growth, then consumers obviously can't kind of keep up with the economy, right? So they're stressed, right, because wages aren't keeping up with the pace of inflation. Even though inflation, the rate of inflation is declining, the rate of growth of inflation is declining, the decline in wages is falling faster than the rate of inflation growth. So there's a fairly large gap between what it's costing people to live and what they can actually afford to pay for. And so that is certainly a concern, but again, not necessarily recessionary at this point, but it is certainly weighing on that side of the ledger in terms of leading to slower economic growth. And Larry in our chat made a very important comment earlier, and so kudos to Larry in our chat this morning. And chat, be sure and like the channel. You can't talk about inflation without talking about GDP, because economic growth is what drives inflation. If you have stronger rates of economic growth, you're going to have higher rates of inflation, because economic growth is all about supply and demand. You have more demand than you have supply, which causes the economy to grow, but supply and demand is also what drives the rate of inflation. So if you take a look at, and that's why there's a very long-term historical correlation between inflation and economic growth. So we've had a recent little uptick in GDP, not surprising, saw a little bit of an uptick in CPI. But the trend of inflation and the trend of economic growth is lower. Economic growth is slowing. It is returning back to our normal long-term trend of economic growth, which is around 2.2%. Which is about where ultimately inflation is going to wind up. and interest rates as well, because those are all tied together. So as you kind of move forward, you're going to continue to see, as wages decline, you're going to see economic growth slow. As economic growth slows, the rate of inflation growth will slow. It's all one big happy family. So that's important because right now there's really no sign of recession in that data. It's all slowing. All suggests that the economy is slowing down and returning to normal, but there's no sign of inflation, no sign of recession. However, small businesses, which make up about 50% of the economy, see a very different picture. The National Federation of Independent Business, their sentiment, their confidence index is near some of the lower levels historically, but is also in very much recessionary territory. So if you talk to a lot of small business owners, they think we're in a recession. They feel like we're in a recession because of what they're seeing in terms of demand and what's happening with their businesses and the cost of things, et cetera. And again, it's important data because it does support a narrative that the economy actually is weaker than headlines suggest. I want to get into some more of this data because it's very interesting. We come back from the break, and it will have an impact on expectations for the market. So I'll talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So we were talking a little bit about last segment, just about, the headline economic data certainly doesn't suggest there's anything wrong with the economy, just an economy that's normalizing. It's not recessionary. It's not terrible. etc. There is data worth considering, though, from the National Federation of Independent Business, which is a survey of small businesses, which makes up about 50% of the economy. So it should not be ignored. It doesn't get a lot of attention, but it is important. And now, again, you have to just keep this all within context of the reality that markets can do whatever they want to do. But there is some stuff worth paying attention to, because there is some correlation to earnings and the things that actually drive the market, which we're about to get to. So if you take a look, so as a small business owner, you have to be optimistic. You cannot be, assuming the world is always going to end and own a small business, because you just won't open shop, right? So business owners by nature are generally optimistic beings. And their expectations for retail sales. So they take a look at the data and they say, okay, what do you think sales are going to be over the next 3 months? And they go, I think sales will be higher over the next 3 months. And then 3 months from now, you ask them, well, what were your sales over the last 3 months? Well, they were a lot lower than they expected. And that's historically the case. Historically, they're very optimistic about forward sales. And reality is always a bit more of a dire picture in terms of reality, right? I mean, they're making sales, they're fine, everything's good. It's just not as robust as they're always hoping. But next quarter, they're always hoping for more. Until now. Expectations for sales over the next quarter are near some of the lowest levels on record, and actual sales are coming in very much in line with what their expectations were. And this is something you normally see at the bottom of recessions, not in an economy that's growing at 2.5%, 3%, as headline GDP is right now. So again, certainly some concerns there on the thing that drives profitability for small businesses, which is sales. If I don't have retail sales, right, if I'm concerned about the level of sales coming in, I'm probably not going to spend money, buying new equipment, expanding my stores, go open a new store. Probably not going to do that, right? So CapEx, so unsurprisingly, CapEx, capital expenditures, have declined sharply over the last few months, even though GDP is still doing fine, right? There's getting to be a fairly significant gap between GDP and what small businesses are doing in terms of CapEx. Certainly tells you that there's a disconnect somewhere that is occurring, because small business owners are very concerned about sales and, as a consequence, are not willing to go spend money within the economy to go expand their business. Another big concern they have is qualified job applicants. There are few or no qualified applicants for job openings, and that level, as is pretty much near some of the highest levels that we've seen. But being able to find workers is a problem for businesses. So even if I wanted to expand my business, and even if I wanted to grow my business more, I would need to hire more employees, and I simply just don't really have that available right now. And the expectations to plan, to raise worker compensation is also declining, because again, if I'm not expecting higher sales, I really can't afford to give people raises. So that's one of the reasons we're seeing wage growth decline on average, because the underlying sales that drive those wages aren't really there. So this is the backdrop for small businesses is certainly not compelling. And there's a reason that this is important, and that is the function that sales, and if we take a look at sales expectations for small businesses, there's a very high correlation to S&P 500 earnings on an annual basis. And if sales expectations are not really rising, and there's more concern about the expectation for sales in the future, then that suggests that earnings may be somewhat at risk in terms of some of the rather lofty earnings estimates that we're currently getting out of Wall Street, who's expecting a very sharp increase in earnings next year. And again, as I know, as we talked about last segment, Larry made this comment, you can't talk about inflation without talking about GDP. Well, GDP is very important to this because if GDP is where earnings come from. So if the economic growth isn't growing strongly, in other words, there's not a lot of supply and demand within the economy creating activity, then earnings, which are a byproduct of economic activity, won't grow either. So if you take a look at a long-term chart of GDP versus the annual change in earnings, again, a very high correlation. And right now, earnings expectations are dramatically higher than the growth rate of the economy. So again, the outlook for earnings are extremely optimistic compared to where the economy is actually growing. So now none of this means that the markets are about to crash and go into a big recession, and nothing is saying anything of that kind. However, with a market that's been up 54% or 52% over the last 2 years, is extremely overbought on multiple levels, and expectations and optimism for stocks are extremely elevated, there is certainly some cause to be a little bit more cautious about approaching markets in terms of investing. Again, rather than kind of being a wild-eye speculator, you may want to tame that back a bit because there is some evidence here that suggests that the growth of the market may slow down next year because earnings are going to get ratcheted down to align with what's happening in economic reality. Also, right now, investors are wildly optimistic about stocks. They're buying everything. Right now, we're in an everything market. Everything is going up at the same time. And the number of stocks that are now moving to above 52-week highs, that percentage of stocks has grown rather sharply. And historically, when you have very broad participation of stocks all achieving 52-week highs all at the same time, that is typically near short-term market peaks. So again, as we said earlier, doesn't mean the markets can't go up from here, because they certainly can. There's a lot of enthusiasm behind the markets right now. We're about to have buybacks. We're moving to the seasonally strong period of the year. But when you have very broad participation, as Sam Stovall once said from S&P, if everybody's bought, who's left to buy? And so normally when you have very broad participation, it's kind of an interesting dichotomy. Very broad participation is bullish because everything's going up, right? It doesn't matter what you own right now, you're a genius because it's all going up in price. But at the same time, it's also a warning sign. Because normally you get very broad participation, you get that exuberance, you get that optimism near market peaks. Because again, everybody's bought. So, just again, there's nothing overly bullish or bearish about the markets right now. There's nothing to be overly concerned about, as we said this morning. We're moving into the seasonally strong time of the year. Buybacks are about to start back up at the end of the month. So a lot of support into the year end. This market can certainly rally into year end. Not much at this moment seems like it's going to stop that, because of just literally the flow of money into the markets is just ginormous. But next year, we could see a pickup in volatility, right? We could see a bit more disappointment in terms of expectations of earnings growth. And, if we see GDP slow down some more next year, if we see employment slow down more next year, those are all going to feed into these factors. And what the NFIB is saying is that some of the optimism in both the markets as well as the economy may be over-exaggerated. That's what the NFIB is saying. Some of the other data that supports that as well suggests that also. I mean, ISM services, which makes up 80% of the economy, is certainly positive right now. It's in expansion territory, but it's not exuberantly in expansion territory, right? We're barely in expansion territory, which really doesn't support a 3+% real GDP. It's more like a 2% GDP growth. So again, we may see stuff slow down next year. That will start to ratchet down earnings expectations. That, of course, is important because markets are based on valuations ultimately, and that those valuations are based on forward earnings expectations. the forward earnings PE ratio, right? The current price to what's expected to be in earnings over the next 12 months is running around 21 times earnings. The peak of that was in 1999 at 25. So we're not far off a peak. So earnings expectations are very elevated. The pricing of the market is very optimistic, expecting those forward earnings to come to fruition. Reality may be very different. And if that's the case, markets are going to have to reprice that next year. So we could see a market next year that doesn't grow at 25% a year like we've seen over the last 2 years. It may be something much more modest next year with a lot more volatility. And again, have no idea. Can't predict that far into the future. All I'm saying is that some of the data doesn't really support the more optimistic outlook. So we're going to need to be careful, and we're going to have to navigate that. Continue to manage risk, as we always talk about. Continue to manage the risk in your portfolio, and then we'll just navigate it. That's all we can do, right? Just got to drive to our destination, whatever that is. All right, be sure to go by the website, realinvestmentadvice.com. Please click the like button before you sign off this video today. We certainly appreciate it. And, of course, if you have any questions or comments, get by realinvestmentadvice.com. Click the Ask a Question button. Let us know what we can do for you. Have a great day. We'll see you back here tomorrow with John Penn.